Bosh, how's it going, everybody? Today we're going to do a super important video. We're going to cover short-term highs, intermediate time highs, and long-term highs. Okay, this is a precursor to a video I've already shot on YouTube, which is trading interim term highs on the lower time frame. And what that video covers is a model which I trade and it's in my trading plan. And essentially what you're looking at is lower time frame order flow to support the higher time frame order flow. Okay, but it's using the same principles of intermediate term highs, long-term highs, short-term highs to frame trend entries on the lower time frame. This episode is going to break down specifically what those highs are and so how to utilize those in your trading. So without further ado, let's get this intro rolling and then we'll jump straight into good stuff. See you on the other side. Okay, just so you know, at the end of this video, in the show notes, I will put a 14-page PDF, which essentially covers exactly what we are going to go through today. So you guys can download that and you can review that at your leisure. But let's go straight into it. A short-term high on its own is not that important, but we need to understand how they form and what they are. A short-term high is essentially a 3-candle formation with 2 lower candles either side of the middle candle. As I said, on their own, irrelevant and not that important. But what is important is that they will form either side of long-term highs and intermediate term highs. That's where they become interesting. Long-term highs are 3-candle formations and they have a short-term high either side. Now, what makes a long-term high different to a short-term high, bar the fact that it has a short-term high either side, is that it has filled a higher time frame point of interest. So this is incredibly important, guys. We have to be expecting price to move in a certain direction. In this example that we're going through today, we'll be looking for bearish price action. So what we're looking for is the long-term high to have filled an inefficiency or imbalance in price on a higher time frame. In this example, we have a 5-minute fair value gap inside of a premium, inside of a higher time frame bearish order block. This is where we would be starting to analyze candles, candle by candle, to get a clearer picture of what price is doing. We can then use this to start framing entries. So a long-term high is a high with a short-term high either side that has filled an inefficiency or imbalance in price at a point of interest. Now, an intermediate term high is different to a long-term high in that it fills the inefficiency or imbalance in price in the displacement leg below the long-term high, okay? So what we're witnessing is a high with 2 short-term highs either side, but the high is below the long-term high. Now, what's important here is that price should now no longer go back above this intermediate term high. Now, why is that important? It's important because it is giving you context of what price is doing in terms of order flow, which can help support you getting into your trade. So if you know that price is unlikely to break through this intermediate term high, this is now giving you an opportunity for you to then look for OTE entries, fair value gaps, and your stop goes above this intermediate term high because you would not anticipate this to get broken. If price does break this intermediate term high, your thesis is probably incorrect and you can step away from the trade, okay? So what we are looking at here is how price is delivering inside of a period of nesting, okay? So nesting is essentially consolidation before we are expecting price to expand. So in this example, expand lower, and we are analyzing these pivot highs individually to get a clearer understanding of what price is doing. Okay, we are not saying this is a low, pivot high, pivot low, higher highs, higher lows. That's not what we're doing. Let's just to clarify once more. A long-term high is a high which fills a higher time frame point of interest. It needs to fill an inefficiency or imbalance in price, and it will have a short-term high either side of it. An intermediate term high is a high which fills an inefficiency or imbalance in price inside of the displacement leg below the long-term high. It will also have 2 short-term highs either side. This is important because it allows us to frame a trade below this intermediate term high. Price should not break above this if we are expecting continuation to the downside. So let's have a look at some examples in some charts so we can get a better indication. What we're looking at here is a trade which I took on Friday the 21st. So essentially, if you're watching this straight off the bat, it was the last trading day. So Friday, this was the trade that I took. I got in at 81.50 and I drove it down to 66.75. And it was using this exact principle: short-term highs, intermediate term highs, long-term highs, okay? So let's go through what we just spoke about. We have here a high time frame point of interest. What we have is a 1-minute fair value gap inside of a premium when I'm expecting lower prices for price to catch up with NQ given the SMT divergence that we had. Okay, what we have here is a SIBI, sell side imbalance, buy side inefficiency, so a fair value gap, a SIBI fair value gap, which has been left unfilled. Okay, now what do we say about a long-term high? And this is on a 1 minute chart. What we have here is a long-term high. Why is this a long-term high? Because it has fulfilled my higher time frame point of interest, which was this 1 minute SIBI inside of a premium. Okay, so we have the short-term high. This is where we have a candle with two lower candles either side, and we have another short-term high here. Now, what I'm looking at is for an intermediate term high to form. Now, an intermediate term high is a high which is below the long-term high, which is filled inefficiencies or imbalances in price below the long-term high. Okay, so at this stage, I did not trade this. Okay, what I was waiting for is to see how price interacted at this level, and as we had already filled this higher time frame point of interest, I wanted this candle to remain below the long-term high, and as you can see, it did. So yes, this candle is not quite below this low, but you'll often get this where the price is exactly the same height, and for me this is still okay. Now what we have on the other side is a short-term high. So we have a short-term high, interim term high, short-term high. This now provides opportunity to take a trade as we have the structure in place that we've just discussed. Right now, the key is if you can combine with time and price, and we had here the 2 p.m. macro, this now provides an entry opportunity, right? So we can take our entry anywhere below that intermediate term high. So if you really wanted to get specific, you could take the low to the high of this range, go inside of an OTE for you to go short, stop above the intermediate term high, right? So if you just went bang on 70.5, which is the sweet spot inside of the OT range, the optimal trade entry, stop goes above the intermediate term high as you're not expecting that to be broken, and then you just tackle your target. And for me, it was all the way back down this bullish order block. So taking out this liquidity, which we had created down here, and running into this order block. And so that was exactly my trade. And just to recap, 81.50 down to 66.75 using exactly this principle. A short-term high, long-term high, short-term high, intermediate term high with short-term high either side, looking to frame an entry around a macro, okay, at a higher time frame point of interest inside of a premium. Okay, so let's have a look at another example. This was on Thursday, the 20th July, for those who want to go back and back test. And what's probably worthwhile here is putting into some context. And this touches on the following video, which I'll put at the end, which I've already shot, which was released a few weeks ago, which is interim term highs on a lower time frame, supporting higher time frame bearish order flow. Okay. Bit of a mouthful, but bear with me. So what I'm looking at here is when on the higher time frame, we have a clear break in market structure. Okay, so we're looking for price to show signs of continuation to the downside, right? We had the sweep of the buy side. We've now had a market structure shift, return into a inefficiency in balance and price. Now we're broken. So now I'm looking for order flow on the lower time frame to support bearish order flow on the higher time frame. Okay, now this is all broken down in detail in following videos, so do make sure you watch that afterwards. But what we have is this candle here. Okay, so this candle is doing what? It's running into this higher time frame order block, right? Mean threshold of this higher time frame order block, which is bumping into this inverted fair value gap on the hourly. Okay, so this is how I utilize it on the lower time frame when I'm using this model. Okay, so what I'm looking at is for price to displace away from this higher time frame order block, right? And we have it here. Now what I'm looking to do is look for an inefficiency or imbalance in price inside of that range, which gets filled. Okay, so here we had a 5-minute fair value gap, which is at medium threshold of this bearish order block below this inverted fair value gap. After displacement, I'm now looking to see price respect this bearish order block onto lower time frame, and we can start using this principle. This is the displacement leg that we had out of that bearish order block. This is that 5-minute SIBI. This is a long-term high. Why? Because it has filled the inefficiency in the 5-minute SIBI, and it has what? It has two short-term highs either side of that long-term high. Now I'm waiting for an intermediate term high to form. Where is that? I'm looking for the inefficiency or imbalance inside of the displacement leg after the long-term high to get filled. And in this instance, we had a 1-minute volume imbalance up inside this old 5-minute fair value gap. Now, what am I looking for? I'm looking for this interim term high to not overtake this long-term high. So when I see another short-term high form either side of this interim term high, now all I'm looking to do is frame an entry inside of optimum trade entry, and my stock goes above this interim term high. Okay, so if you're getting in this and then you're starting to combine with your macros at 2 o'clock, again, this is where we can start looking for price to start displacing lower, right? So return up into an OTE, stock goes above the intermediate term high, and then you're just targeting a lower objective in a discount PD. All right, so there you have it, guys. I hope you found that useful. I will put the PDF inside of the show notes for you to download and study at your leisure. And also, just to let you know, I do have a private Discord server called Red Pill Trading. We have a fantastic community, and I trade live there every single day. So if you'd like to trade with me every single day, I'll put that link in the description below. But until next time, guys, trade safe, trade smart, and I will see you on the other side. Until next time, take care.